All right, let's get right into it. Picture this. It's late October 2025. The UK's biggest stock index, the FTSE 100, is absolutely flying. I mean, it's hitting record highs, investors are feeling great, and then, seemingly out of nowhere, it all grinds to a halt. So today, we're going to be financial detectives, piecing together the clues to figure out exactly what went wrong. I mean, for 9 straight days, it just felt like the market could not lose. This wasn't some tiny little bump, this was a full-on rally. Everyone was optimistic about what the central banks were doing, company profits looked strong. Yeah, the FTSE 100 was the star of the show, and it really felt like that party was never going to end. But then, on Halloween of all days, the market got a really nasty trick. The music just stopped. The index dropped almost 43 points, that 9-day winning streak was shattered, and this wave of caution just washed over everybody. So the big question is, what happened? Was it just one thing that went wrong? Or was it something way more complicated bubbling under the surface? Well, that's exactly what we're going to dig into. We're going to follow the trail of clues that explains this massive U-turn from total confidence back to caution. Okay, for our first clue, we've got to look across the pond because this whole story really gets kicked off by a huge decision from the most powerful central bank in the world. So here's where it gets really interesting. You start to see this gap, this divergence, between what's happening in the US and what's happening in the UK. On October 29th, the US Federal Reserve goes ahead and cuts its interest rates, right? They're trying to give your economy a boost. But that move immediately put the Bank of England in a really tough spot, because now everyone started expecting them to do the exact same thing. And this all comes down to something called monetary policy. The easiest way to think about it is like a central bank's control panel for the whole economy. And their biggest, most powerful lever on that panel, it's interest rates. Lowering rates is kind of like hitting the gas to speed the economy up, and raising them is like slamming on the brakes to cool things down. And yeah, this basically shows you the chain reaction that happens. When a country like the US cuts its interest rates, big international investors who are always looking for the best return on their money, well, they start looking elsewhere. So demand for the US dollar falls off a bit, and that puts all this pressure on other currencies, like the British pound, as those investors try to figure out where to park their cash next. And the effect of all this? Wow, it was immediate and it was stark. With the US cutting rates and the markets betting the UK was next in line, investors just started dumping the pound. It tumbled, hitting its lowest point of the entire year against the euro. This chaos in the currency market, that was the first major crack in the market's otherwise shiny foundation. Now, let's head back to the UK, because this global pressure was getting complicated by a super confusing picture at home. This is our second clue. An economy sending totally mixed signals. It's like trying to drive a car with one foot on the gas and the other on the brake. So on the one hand, you had these really clear signs of a slowdown. The unemployment rate jumped up to 4.8%. That's a nearly 4-year high. Job openings were falling again. All this data was basically screaming that the economy needed help, which would make you think, okay, the Bank of England has to cut interest rates. But, and this is the wild part, at the very same time, people who did have jobs were getting some pretty big pay raises. Total pay growth was sitting at a strong 5%. Now that's a classic ingredient for inflation, and it was telling the Bank of England to do the complete opposite, keep rates high to stop prices from getting out of control. So you see the problem, right? The Bank of England was just trapped. Do you cut rates to fight the rising unemployment but risk making inflation worse? Or do you keep rates high to fight inflation but risk pushing the economy into an even deeper slump? This uncertainty was creating this really nervous energy in the market, just setting the stage for a fall. All that tension and uncertainty was like a pile of dry kindling just waiting for a spark. And our final clue reveals what lit the match. A sudden string of really bad news from some of Britain's biggest and most important companies. And on October 31st, that bad news came in like a flood. Some of the biggest names on the index took a serious beating. The biggest loser of the day was the advertising giant WPP, which plunged by nearly 5%. This wasn't just some minor blip, it was a sign of real, deep trouble. And that plunge was kicked off by this unbelievably blunt statement from WPP's new CEO. After reporting that profits were down, she called the company's performance unacceptable and said she was launching a major review. I mean, language like that from a CEO is basically guaranteed to send investors scrambling for the exits. But it wasn't just WPP, not by a long shot. Auto Trader's stock fell over 3.5% when its COO announced she was leaving, and then the mining company Fresnillo saw its shares drop after investors really didn't like its plan to buy a Canadian firm. It was just a domino effect of one negative headline after another. And look, this wasn't about a few bad apples. The pain was everywhere. The key sectors that are really the backbone of the FTSE 100, we're talking banks, miners, energy stocks, they were all flashing red. This showed a broad risk-off mood, where investors weren't just selling a few problem stocks, they were selling pretty much everything. Okay, so we've got all our clues on the table. We've got global policy pressure, confusing economic data from the UK, and a whole string of bad corporate news. Let's put it all together, solve this thing, and most importantly, talk about what we can all learn from it. So the verdict, it wasn't just one single thing. This was a classic perfect storm. The market had already been climbing for 9 days, which made it what traders call overbought. It was fragile and ready for a fall. The pressure from global interest rates created that initial instability. The UK's messy economic picture added a layer of doubt, and then that bad corporate news was the final push that sent it over the edge. If you're just starting out with investing, this whole event is like a real-world masterclass in a few key principles. It shows you that direct link between interest rates and what a currency is worth, but it also teaches a really valuable lesson about being cautious. When a market has gone up and up and up for a long time, it's often due for a pullback. Chasing that winning streak can be a really risky game. And hey, even for those of us who've been at this for a while, this is a huge reminder of some core principles, right? Diversification is your best friend when entire sectors start falling at once. And it shows that those simple rules of thumb you hear, like a weak pound is good for the stock market, well, it's rarely the whole story. The reality is always more complicated, which is why having a disciplined long-term plan always beats reacting to the daily news cycle. When you really boil it all down, the single biggest takeaway is this. Everything is connected. A decision made by a committee in Washington, D.C. can send ripples across the entire globe and directly impact the value of companies based in London, which in turn affects the pensions and savings of millions of people. And that kind of leaves us with one big question to chew on. In a world where money and information and policy decisions are all moving at the speed of light, can we ever really think of a single country's stock market as being truly local? Or is it all just one big interconnected system? Definitely something to think about next time you see the markets making headlines.